Welcome, and thank you for joining us for a deep dive into the strategic blueprint of a global financial giant. We are tackling Morgan Stanley's 2025 annual letter to shareholders. And, well, it doesn't just look back. It really charts a course for high-speed acceleration.
That's exactly right. Our mission today is, to cut straight through some of that dense financial jargon. We need to distill, I think, three main things: the exceptional performance in 2024, the kind of fundamental shift in the firm's guiding philosophy, this integrated firm idea, and maybe most crucially, the detailed strategy for hitting that extremely ambitious $10 trillion client asset target.
Yeah, this letter feels like Ted Pick's new mandate, really. Built on what the firm calls its four foundational pillars: strategy, culture, financial strength, and growth. We need to understand how these pillars actually translate into, operational reality.
Okay, so let's unpack this. Maybe start with the immediate headline numbers from 2024. Sure. 2024 was highlighted as one of Morgan Stanley's strongest years ever. It really shows deep resilience in shifting markets. The financial scoreboard is, well, pretty impressive. We saw record net revenues hit $61.8 billion.
And right alongside that top-line growth, profitability just soared.
Absolutely. They delivered record net income, $13.4 billion. But the number that I think speaks most clearly to the power of their sort of diversified model is the diluted earnings per share, the EPS. It jumped significantly to $7.95. That's way up from $5.18 the year before.
Wow, that's nearly a 50% increase in EPS.
Yeah.
That signals some serious operational leverage, right? Not just market luck. And the efficiency measure, their return on average tangible common equity, or ROTCE,
Came in robustly at 18.8%.
and for you, the listener, that 18.8% is a critical measure. It really tells us how effectively they're using their core capital to generate profits.
Yeah.
Shows immense capital discipline.
And that stability and strength, it translated directly to shareholders, too. For the third consecutive year, the common dividend went up by 7.5 cents. It reached 0.925 cents per share.
Okay, now here's where the narrative gets, I think, really interesting. All this stability and record performance happened right alongside a massive transition at the very top. James Gorman stepped down as executive chairman. He finished a tenure that fundamentally transformed the firm, didn't it? From a cyclical investment bank into something much more diversified, focused heavily on those predictable wealth management revenues.
It really is the handoff of a lifetime. Gorman, you could say, de-risked and diversified the model. The new CEO, Ted Pick, he's inheriting the stabilized foundation, but his job seems defined by acceleration. His emphasis is clear. Success now hinges entirely on consistent execution across four pillars.
Right, those four pillars again. So let's move past the numbers for a second and look at the how. How do they execute? The core strategic concept they keep mentioning is delivering the integrated firm. What does that actually mean operationally? Is it more than just, corporate buzzwords?
Well, the integrated firm is the strategic North Star because it's the platform that unites their three major businesses: institutional securities, wealth management, and investment management. They state their goal pretty simply: to raise, manage, and allocate capital for everyone from governments and institutions right down to individual investors.
But the real value proposition must be in the seamless connection between those segments, right? Can you give us an example? Like, what does integration look like in practice for a client?
Yeah, a great example is probably the client journey itself. So let's say the institutional security side advises a company through a merger or maybe an IPO. The liquidity event that creates for the founder or the executive team that immediately flows into the wealth management division. It's a direct pipeline. Similarly, high net worth clients in wealth management, they often need sophisticated advice on things like private placements or access to specific investment management products. And the integrated firm ensures that internal handoff is immediate and, importantly, coordinated. It's all about making sure the client never really leaves their ecosystem.
Okay, so that structure itself becomes a competitive advantage. But the letter also makes a really strong case that the real edge lies in their culture. How do they manage to codify culture as a financial differentiator?
They root it in their, 90-year-old philosophy: first-class business in a first-class way. Classic phrase. But for today's strategy, they boil it down to three specific actionable tenets: rigor, humility, and partnership.
Rigor, humility, partnership. That sounds very deliberate. What are the practical implications of a tenet like, say, rigor in the context of a trading floor or an advisory office?
Rigor, well, it ensures the firm avoids those big operational errors and compliance failures that can just destroy reputation and, frankly, capital. It means disciplined risk management, real attention to detail. Humility is crucial because it promotes continuous learning, adapting to market shifts. You can't be arrogant. But partnership, That's probably the key financial driver of the three. Partnership means the different divisions, IS, WM, IM, they must collaborate seamlessly. That's essential for maximizing those cross-selling opportunities we just talked about with the integrated firm model.
And they back this up with internal data, right? They mentioned the leadership team on the operating management committees averages something like, what, over 20 years, tenure?
Yeah, an impressive tenure, over 20 years. That kind of longevity underpinned by these tenets, it suggests they have the institutional stability needed to push toward these massive growth targets.
It signals consistency,
Mhm.
which brings us, I guess, directly to the engine of that growth.
Yeah.
The $10 trillion goal. And that rests squarely on wealth and investment management.
Exactly. Let's talk scale there.
Okay, wealth management. 2024 saw record revenues, $28.4 billion. Tell us about the client base driving those huge numbers.
Well, client assets swelled to $6.2 trillion. That represents over 19 million client relationships. Huge scale. And this scale is achieved through a three-pronged approach. You've got the traditional advisor-led channel, then the self-directed channel like E-Trade, and finally the workplace channel dealing with corporate benefits and stock plans.
But the really key strategic phrase they use, the mandate really, is we must deliver on the funnel. For you listening, that $10 trillion target seems to hinge entirely on this funnel concept. What exactly does it entail? Why is it so foundational to their durable revenue growth?
The funnel is the migration strategy. It means taking clients who start in those, let's say, more transactional, lower margin channels, self-directed and workplace, and actively moving them up, moving them into the higher value fee-based advice channels. It's a difference between a client maybe trading stocks occasionally versus a client paying an ongoing fee for comprehensive financial planning and advice.
And the economic difference there is massive, isn't it? Transactional revenue is volatile, depends on market activity levels. But that fee-based advice revenue, that's sticky. It's consistent, far more durable, especially when markets get choppy.
Exactly. That is the core strategic justification. And they've shown they can execute this migration. Net new assets averaged over $250 billion in the last 2 years alone. And crucially, those fee-based flows, the sticky money, exceeded $100 billion for the fourth straight year. Hit $123 billion in 2024. That consistency is absolutely key if they want to hit $10 trillion.
And the investment management side, IM, that provides critical specialized mass to this whole integrated firm idea.
Right. Investment management complements this growth nicely. They reported $5.9 billion in revenues and manage about $1.7 trillion in total assets under management, AUM. Their success here is really driven by specialized strategies, things like customized portfolios and fixed income. Specifically, the Parametric platform, which offers customized exposure and overlay services, that's grown to an enormous $575 billion.
And it looks like they're also preparing for the next generation of client demand, significantly expanding their alternative investment offerings.
Yes, definitely. They note that investable assets in alternatives have more than doubled just since 2018, up to $240 billion now. So the total client assets across both wealth management and investment management combined, that reached $7.9 trillion at the end of 2024. This just shows their massive scale advantage and, well, positions them squarely on the glide path toward that coveted $10 trillion goal.
Okay, let's pivot now to the institutional securities segment, IS. While wealth provides that durable engine, IS brings the more cyclical but potentially high-margin revenue when capital markets are, hot. They delivered strong revenues, $28.1 billion in 2024. Where did they win, and were there any trade-offs mentioned?
They absolutely captured significant wallet share in 2024, especially as IPO activity started showing some signs of life again. They ranked #1 globally as an underwriter of IPOs and #2 as an advisor on global M&A, both announced and completed deals.
Those are definitely headline wins. But those kinds of lead rankings often come with intense competition. Does the letter give any sense of whether they had to compress margins a lot to win that share? Or is this momentum seen as truly durable and high margin?
They frame it as durable. They point to consistency in their trading business, for instance, holding the #2 spot in equity revenue wallet share. That's a solid 21%. Furthermore, their growth was pretty geographically balanced. Revenue growth across all major regions, Americas, EMEA, Asia-Pacific, was up roughly 20% in each. That suggests they're capturing global market share, not just, riding a hot domestic market.
Yeah, that ability to grow consistently across all geographies really speaks to their integrated firm model operating globally. Let's maybe zoom out for a second and look at the macro context. What does the letter identify as shaping their next 5 years or so?
The firm highlights two central paradigm shifts that, frankly, everyone in finance is grappling with. First, the definitive end of that era of ultra-low interest rates and the reemergence of inflation as a maybe permanent factor. And second, the resumption of global geopolitical uncertainty. That changes capital flows, investment horizons, everything.
But they don't seem to be running from this volatility. They seem to be framing it as a massive opportunity, particularly for their institutional business. What's the core thinking there?
The core thesis, and this is really crucial, is their belief that they are in the early innings of a classic corporate finance upcycle. The idea is that global companies have put off major strategic decisions for years because of all the rate uncertainty. Now they have to restructure capital, make those deferred M&A decisions, pivot their businesses for this higher rate world. So Morgan Stanley is basically betting that this pent-up demand is going to generate a huge wave of future investment banking fees.
That's definitely an optimistic prediction. I mean, maybe high stakes too, especially given the geopolitical headwinds they just acknowledge themselves.
It is, and that's precisely why internal financial discipline becomes so critical. The letter makes a point of highlighting a full-year efficiency ratio of 71%. Remember, the efficiency ratio is just operating expense divided by revenue. Lower is better. Aiming for 70% or below, that's a demanding target. It provides the headroom, the cushion needed to ride out the inevitable cyclicality of the institutional business.
And their financial strength needs to support this ambitious outlook. They mention a robust Common Equity Tier 1 ratio, CET1, right?
Right.
15.9% at the end of 2024.
Yes, that 15.9% CET1 ratio is significant. It acts as their primary capital buffer against shocks. It signals immense stability and the capacity to absorb unexpected market turbulence without disrupting operations or, crucially, that client growth trajectory. It provides the kind of rock-solid foundation necessary to take those strategic risks in that expected corporate finance upcycle.
Okay, so this raises the ultimate question, then. How does all this strategy, all this financial firepower, translate into concrete hard targets for the next few years? What's the actual North Star they're aiming for?
Well, the firm formally laid out 5 specific measurable goals. These define the integrated firm's aspirations, and they really integrate all the different segments.
Can you summarize those 5 goals for us?
Sure. First, client assets. Achieving and, importantly, surpassing $10 trillion. That's the headline. Second, wealth management pre-tax margin, targeting 30%. That's the proof point for the profitability of executing that funnel strategy. Third, firm-wide efficiency ratio, aiming for 70%. Discipline. Fourth, return on tangible common equity, ROTCE, delivering 20% through business cycles. So consistency again.
And the 5th goal is new, isn't it? Reflecting the renewed importance or perhaps the expected contribution of the institutional securities business.
That's right. The 5th goal is institutional securities wallet share, achieving durable share gains. They specifically call this out as a new metric. It signals a move away from relying solely on cyclical market performance for IS. It means the IS business is expected to consistently grow its share of the overall market, whatever the cycle's speed.
Now, hitting these efficiency and growth targets at the same time, especially that 70% efficiency ratio alongside massive asset growth, they must be investing heavily in automation and scale, right?
Yeah.
It's notable they explicitly name one area as key to their future.
They do. They are investing heavily in artificial intelligence, AI. They clearly see AI as the essential tool to gain significant efficiency and scale across the entire integrated firm. And this isn't just about, back office optimization. It's about scaling the wealth management funnel, using AI to personalize communications, rapidly onboard new clients, maybe support advisors with sophisticated data analysis to drive that cross-selling.
So the path to that 30% margin in wealth management and the 70% firm-wide efficiency ratio is really paved with AI investment. It links the high-tech spending directly to their long-term fee-based revenue goals.
It connects every single part of the strategy, doesn't it? The integrated firm is the structure. Rigor and partnership, that's the culture. The funnel provides the durable revenue stream, and AI provides the leverage, the power to achieve the massive scale and profitability demanded by those targets.
So this deep dive, it really reveals a firm that managed to achieve record performance in 2024 while navigating a huge leadership change, and at the same time, codifying a very clear integrated strategy focused on those durable fee-based revenues and now acceleration.
I think the core takeaway for you, the learner, is understanding this deliberate choice Morgan Stanley has made. They genuinely view their cultural tenets, rigor, humility, partnership, not as some abstract, soft skills. They see them as the operational competitive advantage, the advantage that enables consistent execution, which seems to be the only way they believe they can transition successfully from Gorman's diversification era to pick acceleration era, especially in such a volatile environment.
Morgan Stanley certainly sounds confident about achieving that $10 trillion client asset target. They're citing the early innings of a classic corporate finance upcycle as a major driver, particularly for the near term. But given the geopolitical uncertainty they themselves talk about and the sheer operational challenge of migrating millions of clients through that funnel, it makes you wonder, which of those two primary growth strategies, the steady, reliable, detailed execution of the wealth management investment management funnel, or the speed and maybe sustainability of that institutional securities upcycle, which do you think will actually be the single biggest factor in hitting that massive $10 T target? Something to perhaps mull over as you explore these topics further.